To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Now let's have a look at a question from July 21 paper where we are required to prepare consolidated profit and loss account. Now if you look at the question for the first time, you may feel that there are a lot of confusions and complexities, but if you keep your calm and if you apply the concepts that you have learned, you will be able to solve this question without much of an issue, right? So let's have a look at the question. The trial balance of X Limited and Y Limited as on 31st March of 21 are where as under. So, two trial balances have been given. We will ignore the amounts for now unless there is a specific need to do that. So, you have equity share capital of both the companies, 7% preference share capital, Y Limited 4 lakhs, that is 400,000, right. Then there are reserves, there are 6% debentures, trade receivables and trade payables, profit and loss account balance credit of 40 and 30. Then purchase and sales have been given, wages and salaries and debenture interest if you see 24 and 24, so that takes care of the full year's debenture interest, general expenses, then preference share dividend up to 30th September 2020. In X Limited there is a credit of 7,000 and in Y Limited there is a debit of 14,000. What does this mean? Y Limited has paid 14,000 of preference dividend and X Limited has received 7,000 preference dividend. Now this 7,000 can be from some other preference shares also, but if you look at the additional information, you will see that X Limited also owns preference shares in Y Limited. Okay. Then inventory has been given as on 31st March of 21 at 200 and 100. This is the closing inventory. If closing inventory is given in the trial balance, it means the impact of opening inventory and adjusting the purchases and all of those things have already been given. Now these concepts we have already learnt at a foundation level and also as a part of group 1 accounting, right. Then cash at bank is given, investment in Y Limited 1056 in thousands and fixed assets, that's your property, plant and equipment 2200 and 1580. This is the trial balance. Additional information, investment in Y Limited was acquired on 1st of July of 2020. So, whatever is the investment made, that was made on 1st of July of 2020 and consisted of 80% equity share capital and 50% preference share capital. That is why if you look at the trial balance, you will see Y Limited has paid 14,000 but X Limited has shown as a credit only at 7,000. Now, when did the acquisition happen? 1st of July of 20. So, from 1st of April 20 till 30th of June of 20, for these 3 months, this is the pre-acquisition period, and from 1st of July onwards till 31st March of 21, that is the post-acquisition period, right. Now, let's look at the other information. After acquiring control over Y Limited, X Limited supplied to Y Limited goods at cost plus 25%. The total invoice value of the goods being 1,20,000 and 1/4 of such goods were still lying in the inventory at the end of the year. Now we know that whenever there are intra-group transactions, that has to be eliminated. Now what does this information tell us? That goods at invoice value of 1,20,000 have been sold. Now just don't think that there is an inventory adjustment. There is a sale from Y Limited to X Limited. Means this 1,20,000 is appearing as a sale in Y Limited's trial balance. It is appearing as purchases in X Limited trial balance. So both of these have to be eliminated, right? And whatever is unsold, to that extent we need to calculate the unrealized profit. Why? Because X Limited would be showing 25% of those goods as their inventory at invoice value, which includes profit of Y Limited, and we are consolidating the profit and loss account. When we are preparing consolidated financial statements, such intra-group profit should be eliminated, which is unrealized, right? Then depreciation to be charged at 10% in X Limited and 15% in Y Limited on fixed asset. That's a simple adjustment. You are required to prepare consolidated statement of profit and loss for the year ended 31st March of 21. Now, one thing that you need to keep in mind in this particular question is the acquisition date. When did the acquisition happen? 1st of July, which means the entire profit of the subsidiary will not be taken to the consolidated P&L. There will be a portion of pre-acquisition profit as well, for which we need to calculate the profit of the subsidiary separately. And from that profit of the subsidiary, we will see how much is pre-acquisition and how much is post-acquisition, right? So, and other adjustments are pretty straightforward. Intra-group transactions you will eliminate, and as far as P&L is concerned, you will add line by line the respective items, eliminating intra-group transactions and arriving at the profit and loss account balance, right? And also keep in mind that we don't have 100% control on the subsidiary. There will be a minority interest as well. As far as equity shares are concerned, 20% of the profit would belong to the minority shareholders. So that part also needs to be computed and shown in the consolidated P&L. So after having understood this, let us start solving. We will prepare few working notes that are required, and then we will prepare the consolidated profit and loss account. So let's start with the solution. First we will prepare the standalone P&L of the subsidiary, from which we can identify how much is the minority interest which has to be eliminated from the consolidated P&L. Also in this case, there will be a portion of pre-acquisition profit, because acquisition happened on 1st of July, right? So that amount can also be computed by preparing the standalone financial statement of the subsidiary. And we are required to only prepare the P&L, right? So for Y Limited, this is working note, just mark it as 1. So what is the revenue from operations given in the question? Revenue from operations, you can look at the credit side, it is given 1900. So all amounts are in thousands. Okay. So 1900 is the revenue from operations. Then from the revenue from operations, we have to reduce the expenses. So less expenses. What are the expenses given? Purchases have been given. Purchases as 1200, and closing inventory is given in the balance sheet, which means these purchases are adjusted purchases, or you can take them as cost of materials consumed, right? So cost of consumed or adjusted purchases, also you may name them, that is 1200. Okay. Then wages and salaries. See, this is a working note, so it need not be in the specific format as prescribed by the Companies Act. You can prepare as a working note as well. Wages and salaries 300. Then general expenses. General expenses is given to be 120. Then you have debenture interest. Debenture interest is 24, fully provided for, there is no outstanding. And then the question mentioned that there is a depreciation required, which is at 15% on fixed assets. So what is the fixed assets? 1580. So depreciation is 15% of 1580, right? So how much is that? 1580 multiplied by 15%, it is 237. Okay. Total expenses is the sum of, so you can just add them, 237 plus 24 plus 120 plus 300 plus 1200. If you add them, you get 1881. So, and there is no information about taxation and all. So profit, you can simply say profit for the year is 1900 minus 1881, that comes to 19,000, right? Now this profit for the year is available to the preference shareholders and the equity shareholders. Now whenever you are preparing the consolidated P&L, we are looking at from the angle of the equity holders of the company. How much will the equity holders get from this profit? Now out of this 19 of profit, we have to remove the portion pertaining to preference dividend. Now if you look at the question, you can see the preference share capital carries a dividend of 7%. How much has been paid? 14 has already been paid as per the trial balance, and there are two assumptions possible. If these are non-cumulative in nature and dividends have not been declared, you can assume that the balance 14 will not be paid. Or if you assume that these are cumulative dividend or dividends have been declared, then maybe we have to provide for those preference dividends which have not been paid, that comes to 14,000. So from this, less preference dividends paid. See, this adjustment happens in the reserves and surplus of the financial statements, but right now we are trying to figure out how much is the profit available to the equity holders. Okay, so paid is 14,000 and payable for balance 6 months is 14,000. So if you want to see how much is payable, you can say 400 multiplied by 7% divided by 2. Why divided by 2? Because for 6 months dividends have been paid, for the balance 6 months dividend is not yet paid. So how much does this come to? This comes to 28, right? So if you reduce this 28, profits available to equity shareholders. Profit available to equity shareholders, 19 minus 28, There is a loss of 9,000. There is not a profit, there is a loss. So, subsidiary has reported a loss of 9,000. Now, what do you do with this 9,000? There are two aspects to this. One, 20% of this belongs to the minority shareholders, that we are clear about. And whatever belongs to the holding company, out of that, 3 months pertains to the pre-acquisition period and 9 months pertains to the post-acquisition period. So, we have to split it accordingly. There are two ways to look at this. Minority share is 20%. So, 9 multiplied by 20%, 1.8, that is 1800 belongs to the minority shareholders. 1800 belongs to the minority shareholders. Balance attributable to group. How much is the balance attributable to group now? 9,000 minus 1.8. 7.2 is attributable to group. Out of this, pre-acquisition loss is how much? This is 3 out of 12 months. Okay, so 7.2 multiplied by 3 divided by 12 is pre-acquisition loss, that is 1.8, and post-acquisition loss is 7.2 minus 1.8, this is 5.4. So, what did we do here? If you try to summarize it, profit of subsidiary, here it is a loss. So, there is a loss of 9,000. Okay. Then, out of this you compute how much is pre-acquisition, how much is post-acquisition. So, pre-acquisition, post-acquisition. Okay. How much is pre-acquisition? Pre-acquisition is for 3 months period. So, this multiplied by 3 divided by 12, that comes to 2250, and post-acquisition is 9,000 multiplied by 9 divided by 12, that comes to 6750. Out of this, minority 20%, how much is that? 2250 multiplied by 20%, that is 450, and this is 1350. Okay, and group's share is 2250 minus 450, 1800 and 5400. So, these two, 450 plus 1350, 1800 will be attributable to minority shareholders. You will reduce it from the consolidated P&L. Pre-acquisition, you will reduce it from the consolidated P&L, and what will you do? You will adjust it against the cost of investment. Now, here adjustment means, will you add or will you reduce? You will add. Generally, if there is a profit, that profit you reduce from the cost. If there is a loss, that loss you will add back to the cost of investment, right? So, this 1800 will be added to the cost of investments, right? This takes care of the subsidiaries P&L. We have identified how much is the profit which is available to the equity shareholders. Now that we have prepared the standalone profit and loss account for the subsidiary, let us start preparing the consolidated profit and loss account. Now, what I suggest is you leave one full page for the consolidated profit and loss account, and in the page after that you can start preparing the relevant notes to the financial statement. So, consolidated statement of profit and loss, right? You can add profit and loss account, profit and loss of X group, that is X Limited group, for year ended 31st of March of 2021, right? So, these are consolidated financial statements, and have particulars, amount, particulars, note and amount, right? So, what is the first item? What is the first item? You have revenue from operations. For this, we will prepare a note, note number 1, and from that note, we will pick up the amount, right? So, we will prepare the notes. Notes to financial statement, note number 1, revenue from operations. So, one another way to prepare these financial statements is to have particulars, amount of X company, Y company, any other adjustments, and then the final amount in the last column, right? But the expectation of the institute is generally to prepare the financial statements as per the format. So that's why we are preparing it separately, the consolidated P&L and then the respective notes to accounts, just to ensure that you don't lose out marks in the examination, right? So revenue from operations, we have X Limited, we have Y Limited, and then we have intra-group sales. What is the revenue from X Limited? It is 1800. What is the revenue on from Y Limited? 1900. What is the intra-group sales? It is 1,20,000. So minus 120. Okay. So once you do this sum, you get 3580. 1800 plus 1900 minus 120, 3580. This one you can just pick it up here. 3580 revenue from operations. Okay. Then total revenue is this amount 3580. There is no other income to be reported. You might be wondering, why are we not taking preference dividend as the income? Two things here. First, after the acquisition, the dividend is within the group and hence there is no income for X Limited. So, with effect from 1st of July, whatever is the dividend which pertains to X Limited, that 50% share in preference dividend, that is not income from X Limited because that is an intra-group transaction. You will anyways eliminate that. So, that will not be considered. And dividends before the acquisition date, we will see what will be the adjustment, right? We will apply the principles of investment accounting and see what will be the adjustments there, right? So, total revenue is done, then let's go to expenses. Expenses. So, under expenses, we have cost of materials purchased, or you can have consumed. This is note number 2. Because inventory is given separately, we are using purchase stroke consumed. Okay, again here we have for X Limited and Y Limited, what is the amount given in the question? 1000 and 1200, and again there is an intra-group purchase. So, less minus 120, and if you sum this up, it will be 2200 minus 120, 2080. Now, you may be wondering, what is the fun in reducing here and reducing here when it will have a contra impact? The simple reason is you are showing from the group's perspective what is the revenue from outside the group, right? So, 2018 is the cost of material purchased. Then you have wages and salaries, which are employee benefit expenses. For this, we will have note number 3. Then you have finance cost, which is interest, for which we will have note number 4, debenture interest. Then we have depreciation, for which we will have note number 5. And we have other expenses, the general expenses, for which we will have note number 6. I have not taken changes in inventories because opening inventory related details are not available. So, and we will assume that this has been adjusted here itself, right? So, no need to show it separately. Okay. So, let us prepare for each one of these. Employee benefit expenses. So, wages and salaries 200 and 300. Wages and salaries, X Limited 200, Y Limited 300, the total comes to 500. We will pick this up 500, right. Then we have finance cost, debenture interest, there is nothing outstanding. Debenture interest, X Limited 24, Y Limited 24, that is 48, okay. Then we have depreciation for X Limited and Y Limited. How much is depreciation for X Limited? X Limited, the question says depreciation to be charged at 10%. So, 2200 into 10%, which is 220, and Y Limited we have already computed, but again we can compute it. 1580 multiplied by 15%, that is 237. 1580 multiplied by 15%, 237. So, the total of this comes to 237 plus 220, 457. So, the total finance cost is 48 and this is 457. Then we have other expenses. The question mentions other expenses as general expenses 160 and 120. So, you can have a note for this. X Limited 160, Y Limited 120, that comes to, the sum of these two comes to 280, right. These are all the expenses. So, let us see what are the total expenses. Total expenses are 280 plus 457 plus 48 plus 500 plus 2080, that is 3365, and profit, they have not mentioned anything, so we will assume it at profit after tax, taxation is not given. Profit after tax is the total revenue minus total expenses, which is 215. So, now we have computed the profit after tax of 2,15,000 at the group level. This includes profit of the holding company, losses from the subsidiary company. Now, we are yet to give the impact of preference dividend and minority interest, right. If you remember, from the subsidiary, there is a loss which is attributable to minority interest, which have to be eliminated. Also, before we arrive at the minority interest, there is a portion of preference dividend which is payable both within the group and outside the group, that also needs to be adjusted. So, first we will calculate what is the preference dividend portion which has to be adjusted, and then we will see the elimination of minority interest and then arrive at the total P&L balance, right. So, make a working note number 2, one is already prepared earlier, right, preference dividend. Now, what is the total preference dividend as far as the subsidiary is concerned? The subsidiary has to pay 7% on 4 lakhs, and we have assumed that 14,000 is paid and 14,000 is still payable. So, total dividend is 28. Total dividend is 28,000, right? Now, out of this, there is a portion which is for the post acquisition period, and there is something which is paid outside the group. So, again we have to analyze this total 28,000 of preference dividend and see which portion has to go where. Okay. So, first let us do pre-acquisition and post-acquisition. What is pre-acquisition? Acquisition happened on 1st of July. So, for the first 3 months, whatever is the dividend, that is pre-acquisition. So, 28,000 multiplied by 3 divided by 12, that comes to 7,000, and post acquisition is 28,000 minus 7,000, 21,000, right. Now, as far as this post acquisition is concerned, 50% would have been received by the holding company and 50% was paid outside the group, right. So, the 50% which is received by the holding company is an intra-group transaction, and we will not show it as a outflow in the P&L or an outflow from the P&L balance, because it has moved from P&L of the subsidiary to the P&L of the holding company, right. So, what is that is outside the group? 50% of this, right. This 10,500 which is paid outside the group, definitely you will have to show it as a reduction from the consolidated P&L balance, and within the group, that is another 10,500. This will not be shown anywhere because this is lying within the group. From one pocket you have removed that amount, kept in another pocket. So, there will not be any income or there will not be any outflow as far as the group is concerned. Okay. Then pre-acquisition, if you see, again there you have 50% which is paid outside the group and 50% which is paid within the group. Now, one thing that you need to understand here is, though this dividend pertains to pre-acquisition period, this would have been paid after the acquisition because it says as on 30th September, and the remaining part will be paid on 31st of March. So, the dividend for the entire year is paid after the acquisition, and the holding company will receive its share. How much will it receive? It will receive 14,000. It will receive 14,000, which we will not consider in the P&L. That is very clear, because this is going from one pocket of the group to the other pocket of the group. Will we consider this 14,000 which is paid outside the group? Definitely yes, we will consider, because this has been paid to the shareholders which is outside the group. Subsidiary is paying it to outsiders. So, that is definitely an outflow. So, here after profit after tax, preference dividend, right. How much is the preference dividend? First portion is outside the group. How much is paid outside the group? Pre and post put together, 10,500. 10,500 plus 3,500, that is 14,000. Okay. Then within the group, will we make any adjustment? See, this 10,500 which is post acquisition is an outflow from the P&L balance of the subsidiary, and it is an other income item in the holding company's in the holding company standalone financial statements, correct? So 10,500 is moving out of subsidiary company to the holding company. Will there be any impact on the P&L because of this? There will not be, because on one side there is an outflow, reduction in P&L balance, and other side there is an inflow, addition to the P&L balance, so no impact at all. Clear? Now look at the other aspect. This 3,500 which is paid within the group, this is going out of the P&L balance of the subsidiary company, but when you see the holding company's book, holding company would not have taken this as an other income item. Why? Because this is a pre-acquisition dividend, and what do you do with the pre-acquisition dividend? You will reduce it from the cost of investment. Now just understand this critical difference. If you look at the 10,500 amount which is post-acquisition dividend, you have reduced it from P&L balance of Y Limited, and it will get added to other income of X Limited, and it will increase the P&L balance of the X Limited. So basically P&L to P&L, they will set off each other and it will not have any impact. But if you look at the second item, 3,500 which is received by the holding company, will holding company show that 3,500 as other income? It will not show. In its standalone financial statements, it will show it as a reduction from investments. So on one side there is a reduction in P&L balance, but on the other side there is no addition to the P&L balance. It is actually getting adjusted against cost of investment, and hence this 3,500 will be a reduction from the P&L at the group level, because from P&L we are removing this amount and we are taking it to the cost of investment. Now many of you may have a doubt that how is the subsidiary paying dividend? The profits are not sufficient, correct? If you see the workings, we saw that the total profit for the year is 19,000 and dividend paid is 28,000. Is it possible? Maybe possible. They are using past reserves to pay the dividend. Let us not get into those technicalities. They would have paid that dividend, right? So as far as this dividend adjustment is concerned, outside the group you will adjust 14,000 and adjust it to cost of investment. How much? 3,500. This is same as pre-acquisition dividend which you remove from the P&L and you adjust it against the cost of investment. Same logic is applied here, right? So this takes care of the preference dividend related adjustments. Now apart from this, are there any other adjustments? Yes, we have to adjust the minority interest. How much is the minority's share in this particular P&L? So we'll adjust that as well. Less minority shares in Y Limited loss. Okay. Now, so because we have been following in thousands, I'll just add thousands here, 14 here and 3.5 here. Okay. Right. So preference dividends have been adjusted. Now, apart from preference dividends, what all we need to adjust? We need to adjust the minority share of losses from the subsidiary profit and loss, right? Now we have identified how much is minority share in the loss. Now that loss has to be adjusted because this profit after tax includes the loss of subsidiary company, and whatever is the portion belonging to the minority shareholders, that has to be removed. Minority interest has to be removed. Now here if you see 215 is the profit. Had there been profit in the subsidiary company books, what would you have done? You would have reduced that profit which is belonging to minority. But here there is a loss. So instead of reducing from the profit, you will add back, because loss would have reduced this P&L balance, and if you have to exclude the portion related to loss, you will add back. So add minority share of losses, which we have computed as 1800, 450 plus 1350, 1800. So that you will adjust here. That is 1.8. So 1.8 of minority share of losses have been adjusted. Okay. So please note this is minus. So to avoid any confusion, let me add a minus sign here and a minus sign here, and this is a plus sign. Now apart from this, there is also a pre-acquisition portion of loss which has to be excluded or which has to be eliminated from this P&L, and that has to be adjusted to the cost of investment. Had there been profit, you would have reduced the profit and reduced it from the cost of investment. Because there is a loss, you will add it back to the profit and you will add it to the cost of investments. So add pre-acquisition loss to be transferred to investment. How much is that? That is also 1.8. So with this we have completed pre-acquisition losses which has to be adjusted to investment, which is 1.8. Now is there anything left out? Yes, there is an unrealized profit on unsold inventory, that also needs to be adjusted. So less unrealized profit on unsold inventory. How much is unrealized profit on unsold inventory? The total inventory which was sold was 1,20,000. So 1,20,000. And the question says that the goods were sold at cost plus 25%, which means this 1,20,000 represents 125, and we need to know how much is 25 out of that. So 25 divided by 125, this is for the full inventory, and we know only 1/4 is unsold, so divided by 1/4, this is the unrealized profit. So 1,20,000, 120 multiplied by 25 divided by 125 multiplied by 1 divided by 4, we get 6,000. What is this 6,000? This also has to be reduced. So this 6,000 also needs to be reduced. So what is the balance? Balance transferred to consolidated balance sheet. How much will that be? That is 215 minus 14 minus 3.5 plus 1.8 plus 1.8 minus 6. So that comes to 1,95,100, which will be transferred to the consolidated balance sheet.